Okay, all you tax avoiders, this is the rule you've been wanting to save. Go away, save it. And if you're a lefty wokey, please leave a horrible comment about how I am a horrible accountant and I'm a horrible person. Okay, this is actually not a video about you avoiding tax. This is a video about you understanding what happens when you try to avoid tax. So maybe the right guys are gonna probably comment horribly about me too. Guys, when you take money out of your business, it comes out of the company, your business, one of three ways. Wages. Now, wages typically means that you're gonna have to withhold tax. It's gonna go in your personal name and there's gonna be tax somewhere, right? And you also have to pay super guarantee. The next thing is a dividend. Now, dividends as well, they still end up with tax, but there are limitations around when you can and cannot do a dividend. Particularly, you need to have retained earnings in your company to do so. So what I see with a lot of people who want to avoid tax, or maybe they just have no controls around money leaving their company and then probably not paying themselves any wages, is we have this thing called a director's loan. So any money that's private in nature in your company gets shoved into that financial year like a loan balance, right? And it's the next financial year that you start feeling the pain of that loan. And so effectively, this is what we call Division 7A. So it's okay, the ATO is okay with it, the government's okay with it, they haven't ruled it out or anything like that. But effectively, they're going to treat that loan like a commercial loan, which means that there is going to be interest applied as per the ATO benchmark rate. And then there's also going to be a minimum repayment over 7 years. So they want that loan to only last for 7 years. So if, say, for example, we're in the 2026 financial year and we've got the last 4 years of loans, effectively, and we've got some opening balances, I've worked out what the interest would look like on a total loan of $820,000 over the last 4 years. It would amount to $67,000 of interest that is going to go as revenue into your company. And that $67,000 gets added onto your loan, what you've borrowed. So effectively, there's 25% tax on that for the company, which is $16,750 that the company's going to need to find to pay tax on based on your loan, right? But then it gets even better. Now, you're thinking you're being a smarty pants by doing this. When these loans get bigger, they only become like this rolling effect of a domino effect that ends up making things a whole lot worse. So in this scenario here, we've got $175,000 of minimum repayments. Now, you either need to pull cash that you have out of your own pocket, out of your private funds, and put it back in the company. But the reality is, your company probably pays you the wages, and you probably don't have any other source of revenue. So that means that on that 175, there's potentially $82,250 of tax. Now, where this comes, this rolling effect, is that this means that then you need to probably pull this money out of the company to then pay that. So you can see this domino effect. It adds to another loan. So I don't particularly like debit loan accounts, Div 7A. What do you think below? What do you think about tax now?